So the next session is titled Stopping Endless Bailouts, How We Can Prevent Financial Collapse and Solve the Homelessness Crisis. Please welcome Mark Calabria.
DC's bailing out them bankers as a farmer's auction ground.
So before he jumps in, I'm going to do a brief introduction. So few people know exactly how much too much federal government intervention can hurt the housing market better than Mark Calabria. Under President Trump, he ran the Federal Housing Financial Agency, which oversees Fannie Mae, Freddie Mac, and the Federal Home Loans Banks. He was Vice President Pence's chief economist and also served as a senior staffer on the U.S. Senate committee, which handles banking, housing, and urban affairs. His most recent book is Shelter from the Storm, and following his remarks, he will be joined on stage by Todd Zawicki, professor of law at George Mason University and 2023 visiting scholar at CU's Benson Center. Please welcome Mark Calabria.
Thank you so much. I think not mentioned, I'm currently at the Cato Institute, and I take such pride that this summer Cato awarded its Milton Friedman Prize to Jimmy Lai, and to me there is really nobody more deserving. There are a lot of things, I live in Washington, D.C., so you can imagine there are a lot of things that frustrate me, piss me off, and annoy me on a daily basis. But one of those is that the degree to which official Washington has turned its back on Hong Kong is just shocking and heartbreaking. So that was a tough act to follow, given the importance of seeing a beacon of freedom stamped out in our own lifetimes. So maybe on a happier note, I'm going to talk economics. Somebody got that. Maybe I should add as a warning, since I'm going to talk economics, I hope you've managed to have a few cups of coffee before we get started. Maybe you didn't have your usual, because as we all know, coffee is about a third more expensive than it was in January 2021. And I'll tell you, as a regular coffee drinker, that's hit my budget pretty substantially. But my friend Steve Moore talked about this at the beginning. We've had the highest inflation we've seen in 40 years. And this is just insane. And of course, maybe it wouldn't be so bad if wages had kept up with that, but we know they haven't. Real wages have declined, and in fact, they've declined about 5% on average since the beginning of January 2021. And I really kind of think that's the true story of our current economy. Lower real wages, higher real prices. Bidenomics doesn't get any more complicated than that. You pay more for everything and you get less to pay for it with. And again, Steve talked about this, and he did it with these great charts. I'm an Italian American, so I don't use charts, I talk with my hands. So hopefully you can kind of relate to that. But really at the end of the day, it is this massive increase in government spending facilitated by the Federal Reserve that has really made everything in our lives so much more expensive. But rather than rehash what I think Stephen talked about in such an amazing way this morning, I'm going to talk about a particular theme of Bidenomics, which is bailouts. Now, not only because I worked on the banking committee, I think I heard earlier there are a few Texans in the room. I got my start in politics working for Phil Gramm. Personally, I don't think you get much more conservative in politics than Phil Gramm. And Senator Gramm taught me from an early age on the committee. They must have started me pretty early. But it's like bailouts, we are against them and we're always against them. And capitalism and free enterprise doesn't work if you don't take the upside and the downside. And that's how a market economy works. But that's not how that necessarily works in Biden world. Now, it also has the benefit of that bailouts is kind of the theme of my new book. Did I mention I have a new book? But the theme of the book is kind of how you can be subject to requests for bailouts and say no. Before I get to the book, I do want to remind you how big of an issue this is in Bidenomics. Now, some of you may remember, I remember watching on TV when the Dodd-Frank Act was passed. Senator Obama got up, Vice President Biden was right there behind him. You can go look at the video. We were promised no more bank bailouts. It's on the tape. It's not any hedging, it is no more bank bailouts. And of course, you might have noticed back in the spring, we had a couple of bank bailouts. The biggest one of which was, of course, Silicon Valley Bank. And I want to put a little point in context how crazy some of these bailouts are. Now, Treasury Secretary Yellen would have us believe that if we had not rescued Silicon Valley Bank, our economy would come cratering down. And I want to kind of put that numerically into perspective. The losses in Silicon Valley Bank ultimately were about $18 billion. Sure, it's a lot of money to me, and maybe a lot of money to most of you. But at the end of the day, the total market capitalization of all Silicon Valley is about 15 trillion. So the Treasury Secretary would have you believe that if we trimmed about 1,000 off the market cap of Silicon Valley, our economy would crash. I don't find that terribly credible. And maybe let's also, market cap, things fluctuate, but let's put it in terms of revenue. And again, I want to be very clear, I'm not a Luddite, I'm very pro-tech. So nothing I'm saying should be construed as knocking on Silicon Valley. But I don't think my friends should get bailouts. It's not just a question of who gets rescued, but annually Silicon Valley produces about $500 billion in revenue every year. So you think about 18 billion. We are again told by Washington that if Silicon Valley revenues had declined because we didn't bail them out by under 4%, our economy would crater. If you're like thinking, that doesn't add up, you're right. That doesn't add up. There was absolutely no reason for us to rescue Silicon Valley Bank. But I want to give you the reasons it was, in my opinion, rescued. Now, I think I heard a few of you, or at least some are here or moved here from California. I know Steve talked a little bit about the government there. What you may not know, for instance, is a certain governor, Gavin Newsom, called the White House multiple times. And of course, you could have been asking, well, maybe he was just looking out for his constituents in Silicon Valley. Or perhaps you didn't hear that Gavin Newsom has 3 businesses at least with uninsured deposits at Silicon Valley Bank. Fact, this has been proven. By back of the envelope, and we haven't gotten the real numbers yet, is that the rescue of a Silicon Valley Bank saved Gavin Newsom millions and millions of dollars. That is a fact. And I don't know whether when he called up Yellen or Biden said, hey, I've got an interest here, but I'll let you guess what the substance of those phone calls were. And that's just what we know. So the other information, the 10 largest uninsured depositors at Silicon Valley Bank had an average of over $1 billion each in uninsured deposits. Now, personally, if you've got $1 billion in uninsured deposits, please see me afterwards. I want to be your friend. But it's important to keep in mind that rescue saved each of those individuals $100 million they would have lost had we not bailed them out. I think the American public deserves to know who on that list called the White House, who called the Treasury, who asked to be rescued. Because again, the economics do not suggest these rescues were needed. But the connections and the web of patronage suggests that that's why these bailouts were done. And of course, if I'm wrong, the White House is free to relist the call list. They are free to tell us who else other than Gavin Newsom called and who else benefited. But I think it's hard to look at this administration and make any other choice. So one of the reasons I wrote my book, and I hope you take a look at it at some point, is in 2020, when the pandemic hit, I was regulating Fannie Mae, Freddie Mac, and the Federal Home Loan Banks, and I was subject to countless phone calls to bail out Wall Street mortgage firms. I was told that if I didn't, the economy would crater. One of my favorite headlines, I can read you this headline from Politico. It reads, quote, Trump's libertarian housing regulator refuses to bail out mortgage firms with public money, end quote. Now it's Politico. They thought that was an insult. I framed that on my wall, proud of that every day. Of course, we weren't going to spend public money bailing out mortgage firms. But the pressure was intense. The Financial Times, of all places, claimed that I was going to bring the economy to its knees and cause a crash. And I want to give so one of the reasons I wrote the book, other than, the joy of going back and reading nasty things people say about you in the paper, is I wanted to give you a sense of what it's like in a rescue. 99% of the phone calls you get are, please help us out and bail us out. There is nobody on the other end of the spectrum. There's nobody calling you saying it's actually going to be okay. And so we were very data-driven. We engaged with the industry, said, okay, here's the data we're looking at. You heard my earlier analysis, Silicon Valley Bank. We did that with all the mortgage firms. So for instance, at the time, there were 346 mortgage banks that did business with Fannie and Freddie. I had their income statements. I had their balance sheets. I knew who was riding the line. I knew who wasn't. And every time they called and asked for a bailout, I'm like, I'm looking at your financials. You tell me what's changed, because I don't see it. And I'm not going to bail somebody out because they don't want to take 99 cents on the dollar. And of course, you go back to the 2008. This is pretty shocking to me. We bailed out the entire mutual fund industry because Primary Reserve, one of the bigger mutual funds, would have otherwise got 98 cents on the dollar on their Lehman investment. We can't take, our economy cannot take a 2 cents loss, is what they're telling you, on an investment bank. So to me, I think this is utterly crazy. And again, these same people are happy for you to pay a third more for everything you're living on than you were 2 years ago. But I want to take you back a little bit to 2020. I mean, remind you, I mean, housing sales that spring crashed 30%. Probably some of you were in the real estate business. We actually thought early 2020 that prices might fall. Of course, a lot of this is job loss. To put this in perspective, 22 million jobs were lost from February to May of 2020. And to really kind of put that into perspective, that's 2 months, 22 million jobs. In the Great Recession, we lost 9 million over 2 years. So really the contraction of the economy in 2020 was unprecedented, obviously driven by lockdowns and other mistakes that were made. But when we were looking at the mortgage market, we wanted to make sure that we didn't repeat the mistakes of 2008. As was mentioned, I was on the banking committee in 2008. I will tell you, usually if you're staff and you're a member of a committee, most of your day is picking up the phone, yelling at regulators, and then them mostly ignoring you, to be frank about it. They feel like they've got a lot of leeway to do what they want. Not needless to say, I spent a lot of 2008 yelling at regulators. And I also want to be, bipartisan to the extent here. The difference in the mortgage assistance programs between Bush and Obama were a hair. There is very little difference in the approach. I'd love for someone to really walk me through the difference between Hank Paulson and Tim Geithner. I don't see it. And that was the choice we made. I'm going to get back to this topic of Treasury secretaries and personnel choices because they're an incredibly important part of ending bailouts. So I took a lot of my lessons in 2008 and lo and behold found myself being the regulator of the mortgage market in 2020 and said, we're not going to do this again. We're not going to bail people out. We're going to make sure everybody pays. And even when we provided mortgage assistance, what we said is you have to pay it back. We ran it like a business. And if you've got a customer or client that's running into a hard time, yeah, maybe you give them a couple of weeks, maybe you work with them. That's what we did. And I think it's easy to forget that back in 2020, you had people like AOC calling for mortgages and rent to be forgiven. Like, oh, nobody should have, it's a pandemic, nobody should pay their mortgage or rent. And so probably some of you are landlords, and you know how difficult that was on anybody who was a landlord in that avenue. And you see that now. Maybe my friend Todd will later talk about student loans. We're all familiar with the student loan bailouts. The Biden administration today is engaged in a backdoor mortgage bailout using Fannie and Freddie. You've got over 400,000 borrowers who have not paid their mortgage since before COVID. Raise your hand if you think a lot of these people are going to get back on their feet and pay that mortgage anytime soon. And again, they're all sweeping this under the rug. But I want to get back to how did we put this together? We did these programs differently. First of all, we gave forbearance, not forgiveness. We said to borrowers, we'll get you in, we'll give you a couple of months, and you're going to pay us back. Partly this was because our unemployment insurance system is a disaster, and so we were trying to build a bridge for people to be able to get their unemployment. We also didn't penalize people for going back to work, and I think this is one of the incredibly important details that's missed. The structure of the Obama mortgage programs resulted in the fact that every dollar you earned, you lost 31 cents in mortgage assistance. That doesn't count all the other taxes. One of my favorite economists, and I had a really pleasure of working with him when I was at the White House, is Casey Mulligan, University of Chicago. And Casey came out with a book and a lot of papers and really has estimated that don't listen to the people who tell you that the Obama recession was weak because we didn't spend enough. The Obama recovery was weak because large parts of the population lost almost all of whatever they earned and lost assistance. And so, sometimes you get into the stale debates whether people are lazy or not. I'll tell you what, if you put me in a situation where every dollar I earned, I lost a dollar somewhere else, sure, I'm less likely to work. That's common sense. That's what the Obama program did. They took all of these means-tested programs, massively expanded them, and large parts of the population would almost lose all their benefits if they worked. So what Obama essentially did in the mortgage program was punish people for going back to work. So we made sure that when I structured the mortgage programs this way, we wanted to reward you for going back to work rather than punish you for going back to work. And quite frankly, to be slightly immodest, because there were lots of other factors as well, the job recovery we had, I'm going to set aside how crazy it is every time I hear Biden or somebody say that they inherited a recession. Biden inherited the strongest job recovery in American history. The amount of jobs that were being created in June, July, August, the remainder of 2020 was unprecedented in coming back economy. And again, one of the reasons I believe that happened because we didn't set up programs that punish people for going back to work. And I think it's a quite simple thing, but I think it's an important thing in making sure that you structure these programs immediately and do them in a smart way. I also want to say I took the radical approach of paying for everything we did. So I want to put this in the context of compared to 2008, what we did on my watch with Fannie and Freddie, we helped twice as many borrowers, 6 times as quickly, and at a fraction of the cost. The Obama folks spent about $30 billion. We spent close to zero because we charged it all within the mortgage industry. We charged people who needed it back, and we didn't give assistance to people who didn't need it. And so again, we really structured this in a way, and I'll also say as an aside, 2020 was probably one of the best housing markets in a very long time. So again, we were able to do this in a way where you can say no to bailouts, where you can structure assistance that makes sense, where you don't have to add to the deficit, and we can do this in a way, and since you're not adding to the deficit, you're not adding to inflation in the same way. Now, that said, I'm responsible for a small part. I was not responsible for, say, PPP, CARES Act, and many of these other things. I had left the White House at that point, and I don't agree with all the choices that were made in 2020, but I didn't want to put a roadmap together in a book and say, there's a different way to do this. You can have a compassionate, fiscally conservative approach to helping people that doesn't break the bank, that doesn't add to inflation, and doesn't trap people in the joblessness. Now, in fairness, and this may begin slightly immodest, I think if it had been almost anybody else in the job, they would have done it differently. They would have caved in. Because the easiest thing to do in Washington, most people wither under criticism. I find in my daily life, I spend a lot of time with my friend Todd Zawicki because he tells me where I'm wrong on everything, so it keeps me humble and modest. It keeps me prepared for criticism. That's not how most Washington works. The problem with a lot of politicians and policymakers in Washington is what they want most of all is to be loved. And the way to be loved in Washington is to hand out your money. And until we change that dynamic, you're really going to end up with the same results. So I was also disappointed with some of the personnel choices. Early on when I joined the White House in 2017, Vice President Pence tasked me with going through and making sure that our financial regulators would not resort to bailouts. We failed in some of those choices, needless to say. But I want to talk to you about why some of those choices did fail. So for instance, and again, Steve Moore talked earlier. I certainly think Steve should have been on the Fed board. My friend Judy Shelton should have been on the Fed board. Everything that Steve told you earlier about it being a club and a clique and not wanting anybody in, that is absolutely the case. And the war that was waged against Steve and Judy, to me, was just unconscionable. But also, that war wasn't only external. So I think one of the things that people don't recognize, we were this close to getting Janet Yellen reappointed because that's who the Treasury Department and their friends on Wall Street wanted. and we fought tooth and nail to make sure that we could get rid of Janet Yellen. We thought of Powell at the time as a acceptable compromise, that he wasn't as bad as Yellen. The vice president and I were advocates for Stanford's John Taylor, if you know him, or Kevin Warsh, who was on the board, people who we thought would say no to bailouts. And that was just a fight we lost. But I think you really have to appreciate and understand, you need to have a Fed chair that's anti-bank bailout, but you need to have a Treasury secretary. And I want to be clear. Well, first of all, one of the surprises in the book, Steve Mnuchin actually has a sense of humor. I repeat some of his jokes. He told me they're actually kind of funny. I've got my differences with Steve Mnuchin, but this guy's probably the best Treasury secretary we've had in a long time. But again, the problem is so much of the Treasury Department, it is a revolving door between Treasury and the Federal Reserve. 9 times out of 10, if you go over to the Treasury Department, they're going to give you the Wall Street Federal Reserve view of the world. And we really do need to change that internally. And so I want to be very clear. In my view, the next Fed chair has to be an avowed opponent of bank bailouts. I talk a little bit in the book about how Jay Powell would call me up and ask me to rescue X or Y in the mortgage market. And again, he's one of the nicest guys in the world, and that's part of his problem. He cannot say no when people call him for money. And you can't go into these jobs if you want everybody to like you. So again, the Fed really, in my view, helped inflate the housing market in 2020. I had been very clear with them by the summer of 2020. They didn't need to buy all those mortgage-backed securities. They were making my job harder. They were distorting the market. They were distorting affordability. And so a number of ways, making sure we get the right people in place. And this has been a long trend. I'm an economist by training, but I really do think we ultimately need to give the same sort of scrutiny to the Fed governors that we give to Supreme Court justices. These are the people who ultimately determine how trillions of your money will be spent. And the fact is, almost every Republican administration, I worked in the Bush administration, worked in the Trump administration, even under Republicans, by and large, the Treasury Department and their Wall Street friends drive the train on Fed choices. And we ultimately need to absolutely change that dynamic, or we will continue to get Ben Bernanke and Jay Powell as Republican Fed chairs. And there really needs to be a pushback. And I'm very glad you probably have seen, I believe, Trump, Pence, DeSantis have all come out and said Jay Powell's gone. So I can't, I think Chris Christie says he would reappoint him. Got me on that one. But I haven't seen where the rest of the members are. But I'm just, my plea to you is to make sure that we make sure that the Federal Reserve and financial regulators are top choices, because if you don't get the right people there, you're going to get Wall Street people put there who will throw your money at problems every time they arise. So with that, I want to invite my good friend who always asks me tough questions, Todd Zywicki, up here. We're going to have a bit of a conversation. Todd's going to ask me some questions. You get to ask me some questions. I do want to invite you to ask anything. In addition to running FHFA and being chief economist, worked on the Tax Cuts and Job Act, worked on USMCA, was very proud to be part of an administration that actually stood up to China and stood up for Hong Kong. And happy to try to tell you any stories of what it's really like to have been at the White House or in the middle of a crisis. Todd, come on up.
Great. Thanks, Mark. You gave us a lot to talk about here. I will say, though, you know how much I enjoy telling people when they're wrong. So unfortunately, when I talk with you, I never get that opportunity. So, or very rarely.
You're wrong there. But,
let's start off with a question from the audience that I think to sort of do as a starting off point to kind of just frame some background for what you did at the FHFA. One of the people in the audience asked sort of what's going on with Fannie and Freddie. And if you might, but briefly just describe for people here the difference between a conservatorship and a receivership, and why you thought they did the wrong thing, and then sort of where things stand with that.
So for those of you who don't follow mortgage finance every day, which I suspect maybe all of you or most of you, Fannie and Freddie are currently in something called a conservatorship, which essentially it's an administrative bankruptcy. It's an agency running what a bankruptcy court would do. And the easiest way to think about the differences between a conservatorship and a receivership, you may have to correct me from the law side. One is more like a reorganization. You can think about it kind of the differences between a Chapter 7 and a Chapter 11. In a conservatorship, you reorganize, you clean up, you put back out. In a receivership, you have a quasi-liquidation, and it's a much more dramatic. To me, the law required that Fannie and Freddie be cleaned up and put in a receivership in 2008. That was not the choices that were made, and they have, since 2008, been in a conservatorship. And again, this was not supposed to be the case. One of the things that was the top of my agenda that pre-COVID and was still working on during COVID was reprivatizing Fannie and Freddie, getting them off the backs of the taxpayer. These are two multi-trillion-dollar, there's about $6 trillion footprint between the two of them, and the Biden administration wants to make sure you're on the hook for every single penny of that. And the Congress created these as private companies where the losses were supposed to be borne by the shareholders and the creditors, not by the taxpayer. And so we were really putting that in place, and of course COVID hit, and of course the Supreme Court put me out of a job. So I would say for those of you, any of you who ever lost a job, let me tell you, when you wake up one day and being pushed out of it, your job is on the front page of the Wall Street Journal. Everybody knows about it.
Yeah, that's the final chapter of Mark's book describes refreshing the Supreme Court website to find out whether he's going to get fired that day, which is, I think, a very different experience from most of us. And on that topic, you do talk about sort of independent agencies and that sort of thing, and you make some interesting points. For me as a lawyer, sort of conservatives, you kind of deviate a little bit from sort of conservative orthodoxy, and the Supreme Court is going to have another case involving the Consumer Financial Protection Bureau, where the Fifth Circuit has said that their method of funding is unconstitutional, and that's up on review. The CFPB and FHFA look similar at first, but would you speak to what is sort of the independent nature aspect of FHFA? And you draw a distinction, it seems like, with others and the like, which I thought was very interesting in the book.
Well, thank you for saying that. So for those of you who are interested in the debates over a unitary executive and how much independence agencies have, because I was the subject of a Supreme Court case over those issues, I'm not unbiased, but, and I hope Todd feels this way, I think I gave a fair read of the different sides of the conversation. And let me set aside, I'll come back to the removal issue, which was really the subject of the case I was the subject of, and come back to the funding issue. So the way the CFPB, the Consumer Financial Protection Agency, works is it's essentially funded backdoor via the Fed. So the Federal Reserve usually generates earnings. It often generates losses like it has been. But essentially, if you really think about it, they're kind of printing money that goes to the CFPB. Normally, this money would go back to the appropriations process in Congress. So this is money that Congress would otherwise not have to spend. So to me, there is a direct budgetary impact from the CFPB. But more importantly, there's not a offsetting tension. So for instance, I ran an agency that was funded by assessments on Fannie and Freddie and the Federal Home Loan Banks. Now, the importance of this was that, granted, I'm a little unusual in my perspective, and that I think I'm one of the few people in Washington who generally thinks of his job as putting oneself out of a job, because there's so many problems, I'd just like to fix one and then go to the other. That's not how Washington generally works. Again, so their usual tension were if that somebody running FHFA decided they were just going to completely shut Fannie down, half the agency's budget would probably go away. Me, I'd be fine with that. But the normal Washington give and pull would push against that. Same with the controller of the currency. Were Citibank to fail and go away, the OCC's budget would shrink dramatically. And so this is a big difference. The CFPB can literally put anybody and everybody out of business and not suffer any negative consequences to its budget. And so I think that's a real tension there. At the end of the day, I wouldn't be surprised. You have some agencies, the Securities and Exchange Commission is a weird agency of that. It's funded by assessments, but those assessments go through the appropriations process, have to be approved by Congress. My guess is that over time, that's ultimately where most of independent agencies will end up. On the removal, I mean, this is a real tension because you've seen this with Fannie and Freddie. This really gets back to the constitutional question of can the president faithfully execute the laws without being able to remove? And again, this is not just a question of appointees, it's a question of the civil service as well. We've really seen the Biden administration take Fannie and Freddie and use them as a slush fund. And as part of the team on Capitol Hill who created the agency, we didn't want a president to be able to use Fannie and Freddie as slush funds. And at that time, the law was you can't use them as, you can't have that independence. And of course, the law has evolved over time. I will also say a big part of the book is, like it or not, if you agree to take a job in government, your job is to defer to Congress. So despite my time at the White House, despite my time running an agency, I think of myself as an Article I constitutionalist. And what I mean by that is Article I is Congress. That really big, important decisions in government should be made by the people you elect, not by faceless bureaucrats. And I believe that.
As you're speaking, I was flipping through the book and I laughed. You have a line at the beginning of chapter 9 that said, one perhaps can be forgiven for thinking that Fannie Mae and Freddie Mac were created to lose money, right? But this point about, and Charlie Calabrese has written about this also, the politicization of the housing finance system. This is a recurrent problem, right? I mean, you go back to the savings and loan crisis, right? You go back over and over these issues with housing finance and the macroeconomic effects and the political sort of manipulation of the housing finance system, which now seems to be backed up on the back end by essentially we're going to bail out all the banks, the big banks, if it goes south.
I'll give you an example of this, and there are definitely different ways to do this. I mentioned in my remarks that we helped millions of people in their homes, and we paid for it. Not everybody liked the fact that we paid for it. We essentially put a fee on refinancing to pay for the lost loans. So again, I was an independent regulator at the time, and I talk about this in the book. It was made extremely clear to me that White House Chief of Staff Mark Meadows did not like what I was doing. Unfortunately for Mr. Meadows, because I'd come from the Vice President's office, I knew that President Trump was okay with what I was doing. I knew that Vice President Pence was okay with what I was doing. And I knew that Mark Meadows was expressing his own view. So I was safe to ignore it. But being an independent regulator, you have that kind of like, okay, I'm going to follow the law, even if somebody at the White House doesn't want me to follow the law. Because what the law actually requires is for Fannie and Freddie to cover all their costs. It says it right there in the law. They're not supposed to get bailed out. Everything they spend, they're supposed to recover via fees. So we were following that. Now, I get it. I mean, primarily Mark Meadows' concern was it was 2020. It was an election year. He didn't want anything to be any target. He was not thinking about, well, boy, all this excess spending was going to cause inflation. I was thinking about my job is not to add to the deficit. My job is not to give freebies from an agency. My job is to pay for what we're doing. I think if you're not independent, and I had not had contacts within the White House who supported me, and I will say pretty regularly, I read you the Politico line, and there's a great Bloomberg, story about Wall Street blames Calabria for lack of bailout. And the funny thing is, my friends at the White House would email those to me with a thumbs up, keep it up. And so I do want to say, and I know for a fact there were people in the financial service industry who called President Trump directly to yell at me, and he backed me every time. And so you don't always have that. We would have done it anyhow because, I did say every day, and Chairman Powell is lucky that I wasn't getting tweeted at that day. But that said, I think the loss of it, I think agency independence is a complex question, and I hope that I've laid out the various sides of it fairly as it related to my particular case.
We've got a number of questions from the audience involving the Fed, since you raised it, right? And we already talked about the recurrent boom and bust cycles of the housing market. For a long time, we managed to keep a lid on inflation, but we seem to be back into the chasing our tail mode of inflation. It always struck me as somewhat of an absurd proposition that one doesn't even have to be a card-carrying Hayekian to ask, if we don't know the proper price of pantyhose in the economy, how do we possibly know what the price of money should be for the entire economy? Seems like sort of an odd proposition to me. But what would you, and what's your thoughts? I think I'll just ask in generally, your thoughts about the Fed, gold standard monetary rules, what you'd like to see in the future from the Fed, that sort of thing.
So let's kind of divide this in the buckets of kind of, short-term, mid-term, long-term. So it's very hard. I mean, I worked on the banking committee. I worked on bills to bring some oversight to the Fed, and it was a tough fight. You really cannot underestimate the degree that Wall Street likes the status quo, and there is a wing of the Republican Party that Wall Street has a lot of, and there's a wing of the Democrat Party that Wall Street has a lot of influence on. So the ability to block Fed reform is extremely strong. That said, I think it's important you keep fighting that fight. In the interim, this is definitely something where personnel is policy. So as I mentioned, a lot more scrutiny on who we get through and whether we can make sure we get people who are more resistant to bailouts than the people we've had. And I think that needs to be, and you also have to have people who understand how to change the system. The Fed is very chair controlled, like, very modest proposal I've made in the past. And I guess one of these things you can maybe criticize me for actually adding people to the Fed payroll. But if you join the Fed board as a governor, you don't get to bring in anybody. You don't get to bring in an assistant or a scheduler or an economist or a lawyer. You have the Fed chair give you people. So could you imagine trying to provide some counterweight to somebody else who's picked all your staff for you? That's how it works at the Fed. And it empowers the chair, and it empowers the senior career staff. So everything about the structure of the Fed, and we really do need to, some of the, when the Fed was originally set up, there's something called Section 10, which says that there can be no governor from the same district. So for a very long time, you had almost no governors from west of the Mississippi. And so you've got a Fed board that Congress meant to represent America that has repeatedly represented Washington and Wall Street. And I do think there needs to be a much more pushback on that. We get not this sort of faux diversity, but we get diversity of people who lived in small town America. We get diversity of people who disagree. And so I think in the short run, you got to change the nature of who you get on the board. I think in the midterm, you've got to be able to get away with, end up in the dual mandate, move to a more rules-based. And then, if you want to be able to move towards something, I think it'd be very difficult to bring back a gold standard, but I'm not opposed to strengthen it. Got to get the Fed out of bank regulation. Remind you, the Fed was asleep at the wheel on Silicon Valley Bank. Absolutely. But, and there's a very extensive report that makes for some depressing reading, but I'll tell you, having read that report and having been a financial regulator, that report is the norm. That is not the exception. And so I don't want to make you run out and go take all your money out of the bank and put it in your mattress, but you should have pretty much zero faith in the bank supervisors at the Federal Reserve. What you should have faith, when you put your money in an institution, do you trust the CEO? Do you trust the board? Do you trust the management? If you don't think the regulators are going to protect you. You have to look to this quality of the company. And I know that's kind of a harsh thing to say, but I do think part of it is we need to get the Fed out of bank regulation altogether, whether we have that style of regulation. So there's a number of things I would do, some of which I've talked about in the book, some of which I talk elsewhere. I don't know whether being called to wrap up or are we out of time?
Are we out of time?
Okay.
Well, thank you, Mark.
Thank you so
and
much.
I guess he'll be signing books out. You could sign his book, and thanks, Mark.
Thank you, my friend Todd.
Fun.